welcome to TheoTrade. This is Don Kaufman, January 22nd, 2021, doing the TheoTrade weekend update here on a Friday afternoon with markets. Well, they're just morphing into absolute monopoly money throughout the course of this week. I will explain specifically what that entails here momentarily as the retail option bubble just seems to go on. Before we get there, let's give kind of a brief market overview because a lot of the trade action that occurred in this past week is likely to carry forward. And again, we'll explain this in detail right now. First and foremost, this week, you got to take a detailed look specifically at the NASADAQ because the NASADAQ just absolutely caught fire on the week. I mean, again, the NASADAQ futures may do it a little bit of justice, but I'm going to tell you right now, it was all about the monsters of tech. So for those of you that are a little new, maybe have never seen the monsters of tech before, this is a conglomerate symbol that we built. It's like building its own index product, right? It's Apple, it's Amazon, it's Facebook, it's Google, it's Microsoft, all compiled into one nice lump symbol. And one of the first things I want to point out here is that, these products, they hadn't done anything, people. I mean, anything really since what? Late August, maybe early September. And lo and behold, all inside of 1, 2, 3, 4 trading days, we're back on. And we're going to talk about what has actually driven this marketplace higher. And before I do so, though, you really have to look at some of these kind of wild moves. Now, Microsoft is kind of pivoting, if you will, a very pivotal level here and kind of possibly even rejected off of it. I think a lot of people anticipated Microsoft to actually crack through its effective all-time high. And, well, it didn't. Okay, so this is a trade that is going to be watched very, very carefully coming into early next week because it could be, one of the preeminent short opportunities inside of the marketplace. The other aspect you're going to have to deal with, oh yeah, its earnings are coming out. Oh, don't you love actually coming into earnings season with a product almost poised at its all-time high? Obviously, the earnings announcement is going to largely be priced into the options chain. In this particular case, right now, you're looking just over about a $10 expected move. But again, more of that as kind of we jump into next week. It's not just Microsoft. It's Apple. Apple ripping to the upside. Obviously, Facebook coming off of some of the recent lows. Again, this almost looks, if you will, like a full-blown crash to the upside. Again, this goes back to, well, what I'm going to discuss in a second, where markets, again, they're just morphing into pure monopoly money. And you'll see that here momentarily as I display, if you will, some of the option trading that has occurred in a number of these products. Obviously, Google playing a role, Google having just a tremendous breakout. But as I mentioned, we're coming into earnings. Now, Google is not this next week, it's the week after that, but most major monsters of tech are actually going to hit earnings throughout the course of this week. All right, so this is pretty self-explanatory, right? The S&Ps, okay, they didn't necessarily catch fire. The S&P 500 was in effect forced up by the monsters of tech. And again, those monsters of tech really just, exploded the NASADAQ into new highs. One of the key points, though, in here, though, happens to be none other than this. The upside SPX expected move. And I want to bring this to the attention very, very early, okay, in our discussion because the entire marketplace halted after the S&Ps literally hit the upside edge of the expected move. And this is why, week in and week out, we talk about the edges of the expected move. We talk about what the options marketplace is depicting risk to be. And why this is so essential right now is because the options marketplace is what is driving order flow to stocks, to futures, to everything that you're seeing on the screen. To get really specific here, this is a 1 day, 1 minute chart. I'm actually going to back this up just a moment. I'm going to actually take the time frame and knock this out to like the last 3 days on a 1 minute. And I just want you to see that the entire trading week came down to the edge of the expected move. So this is the upper edge, again, the upper edge of the expected move. And in the SPX, the expected move, okay, this past week was approximately $82.50. So in early on in the week, where are we? We started to rally. Literally on Wednesday, we catch fire. Pretty much, before, during the inauguration, we literally hit the upper edge of the expected move. We did our $82.50. We closed on the edge of the expected move. What did we do the next day? Pretty much closed on the edge of the expected move. And last, well, but definitely not least, all of Friday, we just skirted the edge of the expected move. Maybe a little sell side activity into the close, but nothing, people, to speak of. The options marketplace is very, very large and very, very in charge at this point in time. Of course, one of the last things I'll do is update you on the future expected move. And this is, of course, next week's expected move. And we'll do that, of course, during the end of this video. So the SPX holds tight. Now, in a larger sense, and this is why I wanted to really kick off with this. You know, when I do these weekend updates, and when I do a lot of the evening videos, I don't often mention too much about the previous week of trade. Yeah, well, why? Okay, because the previous week of trade, it's in the history books. We can point to charts all day long, but there's one really, really key point in here. The market internals completely break down. And listen, this is not new. You know, it's like, I've seen this movie before, and this movie ends with complete and utter correlation. What I'm referencing in this case is very much this advanced decline line, okay, which in effect did nothing for the marketplace the entire week. We actually had periods of time throughout the course of this week. I mean, specifically today, we opened today with approximately 85 stocks trading to the downside. I mean, that's almost full-blown correlation. That's the kind of trading day that you look at and go, look out below, right? And we ended, okay? Well, the advanced decline line kind of negative, but net, one of the things that you have to recognize, right, is how the marketplace itself, when I say the marketplace, I mean, look around a little bit outside of the SPX. Look around a little bit outside of the monsters of tech, right? We're going to look at energy here in a couple of moments. That broke down. Emerging markets actually sold off a little bit. You look at some of the financials, they sold off, right? What do you got here in terms of Walmart? That didn't do that much this week. Maybe a little bit of a break to the upside. But again, I'm serious with this. Like, look around a little bit. Break to the upside, faded. Intel obviously had earnings, but they loved it right up until the point they sold it. Okay. You take a look at something like Twitter, couldn't get out of its own way. But as I say, look around a little bit because, again, the only performance this week came out of a handful of products. I mean, did you hear anybody talking about Tesla this week? Absolutely not. Obviously, it's got earnings coming up, but nevertheless, it has been non-existent. The only thing that was in play this entire week, okay, was what? It was your Microsoft, your Apple, right? Your Facebook, your Amazon, your Google. That's it, people. And I can show you some stocks on the, peripheral, and we'll talk about, game here in just a second. But, listen, that ain't moving markets. Stocks that are like little minuscule things that are having these explosive moves, they're not moving markets. Okay. The S&Ps, the NASADAQ, they were just being battered around a little bit by the monsters of tech and then completely stalled out. And that's one of the things that you have to look at coming into this next week of trade, because I'm going to tell you right now, right? Yeah, that'll work until the music stops. And that's exactly where I'm going to head here momentarily. Like, is the music about to stop? Before we get there, let's talk a little bit about, well, our title this weekend. And it's the markets look like they just morphed into outright monopoly money. That's a pretty strong statement, but I'm actually going to qualify that statement. We'll start, okay, with GME, which is, of course, GAME or GameStop. All right, what do we see inside of GameStop? There was constant discussion of this today. You know what? I have to put it on an intraday chart to really get a good feel for it. It was starting the day at about a $44 stock, actually hit, well, 76 and change before it actually came crashing down. Only see a rally again. This is not what is impressive, okay? What is impressive, first of all, the number of tweets and chats about this going on the side was nothing less than awe-inspiring. The fact that it actually traded 2.1 million option contracts is just outright alarming. This was like a full-fledged coordinated attack on one underlying. There's nothing more that I want to detail other than this exemplifies what I was talking about in last week's update. You know, in last weekend's update, I specifically said it's a retail-fueled bubble. It's just, this is just providing more evidence. And I don't think that, you know, is GameStop going to be a good trade? Of course not, right? This, I'll tell you what, this is a market maker's, like, this is heaven for a market maker. They just come in here and scalp bid off for spread, and you as a retail trader, you just get ripped apart. I mean, you get completely ripped apart. Do you realize, okay, do you realize, look at the number of contracts that traded in here. 2.1 million, right? Look at the number of contracts that traded at the bid or below. Almost 600,000. Traded at the ask or above. Over 600,000. So net, out of the 2.1 million contracts traded in there, you had about 1.2 million of those contracts. Yeah, 1.2 million of those contracts, they're just market orders, okay? I mean, people, you have to understand, in a marketplace like this, you got to be a few fries short of a Happy Meal to go in there and do a marketable order. And yet, okay, over half the flow in here were market orders. And you can see that, okay, designated right here. And again, I don't mean to offend. I'm telling you right now, if you're doing market orders in a product like this, you're giving your money away. Spent 15 years in the brokerage business, and no one's ever seen anything like this. I mean, I even called around a little bit here in the after hours and have been talking to a couple of traders, and they're like, it's just a total free-for-all. I mean, it's like a candy store for a market maker because the bid-offer spreads in a product, you know, with what? Almost a 300% implied volatility. The bid-offer spreads are so wide, you could drive a Mack truck through them, right? People are just like, oh, it's at 1020, buy it. It's crazy. Now, okay, that isn't going to be a big market mover. And that's why, you know, I'm less inclined to talk more about GameStop. Okay. What I am inclined to do is it makes me realize that the entire marketplace, okay, I call it monopoly money, but really monopoly is old school. Okay. This has become Xbox for a lot of people, but with money. That's it. You know, I know the reality games have become not so fun. So, well, people have turned on to Xbox with money inside of stuff like GameStop. But it doesn't stop there, okay? Take a look at stuff today, specifically like Microsoft. Now, Microsoft, again, ripped, peaked out of the gate, and actually faded throughout the course of the day. Look at the number of option contracts that traded in here. Now, obviously, this pales in comparison to something like GameStop. Nevertheless, okay, 500,000 calls traded versus 128,000 puts. Now, again, this is not exactly off the charts, but most of this, and I want to reiterate this, most of the size that traded in here, okay, most of that size came right in the front of the trading session, meaning that most of that was actually done when the marketplace was flying high. Next, we move on to something like Apple. Apple, okay, does that speak volumes to you? 2 million calls, 600,000 puts, all right? It's, again, awe-inspiring. People, this is day in and day out, all right? Facebook. What do we got inside of Facebook? Wow, this was actually light. In fact, Facebook literally traded light. The irony, it didn't move anywhere today. And it goes on and on. Also, an interesting kind of irony that Tesla, its volume throughout the course of the week has actually been drying up. Tesla didn't even do 1 million option contracts today. Oh, I'm sorry. It's not, you know, with the in crowd at this point in time. But if you can move, and the point I want to make with this, you move Microsoft, you move Apple, you move Facebook, you can move something like Amazon or Google, you can move the S&Ps, okay? And these call buyers, these are targeted exercises towards these underlyings with professionals just tagging along with it. All right, so the retail option bubble goes on, and you can feel it, you can taste it, all right? GameStop is just, it exemplifies it. And it just points out like what everybody's been, you know, thinking, okay? But today was all out like war in one ugly little underlying that nobody even cares about, okay? But in the end, it has become just that, almost like monopoly money. And of course, all of this works until the music stops. Now, the S&P rally. Let's jump back to a little bit more discussion of the marketplace. The S&P rally, it got put on hold. One of the things, again, that I wanted to reiterate, and this time I'm actually going to bring up the spiders for it, okay? The spiders ripped to the upside. That was it. It was literally a flash in the pan. It happened on Tuesday, Wednesday. Of course, the marketplace was closed on Monday. It happened Tuesday, Wednesday. We flattened out and actually sold off mildly, of course, into the close here on Friday. So it stalled out, okay? Because the S&P 500, it needed the financials in order to continue to propagate gains. And one of the things that I've been talking about, and again, this is, you know, I hate to like look back at this previous week, but one of the things I've been talking about, if you don't have the financials with you, you're not going up in the S&Ps, period. There's no if, and, or but about it. And the financials, okay, in effect, stalled out the entire marketplace. Look at the auto expected move here. In fact, I'm going to zoom out for a second. Look at the auto expected move. The financials literally tagged the lower edge of the expected move and closed right on it, people. The S&Ps tagged the upper edge of the expected move. So yes, the S&Ps were driven higher, but again, they were halted in their path specifically by those financials. All right, energy this week also took a hit. I'm just putting that a little secondarily. You know, the energy sector has tendency just to kind of follow suit with whatever the financials are doing. It backed off a little bit. The energy actually, it tagged the lower edge of the expected move today, rebounded kind of mildly. But when you start looking at like energy plus the financials is enough to actually stall out the S&Ps. Critically important this next week, because if we see any continued sell-side activity specific to the financials, it is going to reverse course of the S&Ps. Now, the sell-side activity in the financials could be generated by the financials or could actually be generated by the bonds starting to rally back up. Think about that. The bonds have been completely mellow the last 2 weeks after having just feverish downside movement. Okay, the bonds almost look poised to start back to the upside, but I don't want to get ahead of ourselves because I think that trade, okay, is a pure gamble at this point. Again, the bonds have sustained a range between 168 and 169. A break to the upside in the bonds assuredly will start to sell off the S&Ps because it will force the financials down, okay, as interest rates start to go, well, back down. Next on the docket, tech earnings. Not too much to mention on this, other than when I say tech earnings, it's everything we've been talking about here, right? Take a quick glance. You've got Microsoft on the plate, right? You've got, our favorites here, Apple. It's going to be a big monster of tech kind of week. And as of right now, good numbers, they feel like they're already priced in, okay? Well, that kind of remains to be seen. And again, we'll get a better feel for this. Obviously, Amazon's going to be a little bit further out in time. Google's a little bit further out in time. But hey, again, the main course is being served. You've got what? You've got Microsoft, you've got Apple, and you've got Facebook. With that, again, these have been market-moving events, and they are pricing in phenomenal numbers right now. And you have to kind of question, is this a buy the rumor, sell the news? Okay, be careful. We're going to be looking, okay, constantly at the expected moves throughout the course of this week, specific to some of the tech earnings. Next in the docket here, TheoTheta portfolio. Now, the TheoTheta portfolio, if you guys have been kind of tuned in and turned on, this is a portfolio we're actually constructing specifically to be able to sell premium. Really, all that I did throughout the course of this week, I allocated a bit more, but I was very specific and I allocated out of the money calls in the NASADAQ. Why? Because the NASADAQ caught fire to the upside. And for me and what I'm trying to do, okay, to start to really build some decent allocations, this upward momentum inside of the NASADAQ, again, that upward momentum provided a perfect opportunity to sell way out of the money options here. And again, that's precisely what we did In this particular case, went a little further out in time. We went way out of the money. We got on some great premium. And again, the QQQ, what did it do? Stalled out really this last two trading sessions, which is fine. It's kind of par for the course, right? One aspect with that is, as you take a looking at this, you know, the theta, it just keeps rolling in. And when I say the theta just keeps rolling in, is as soon as the marketplace stalled out. I mean, most of the price action this week was actually done on Tuesday, Wednesday. You know, Thursday, Friday, marketplace didn't do much, but the theta kept rolling in. You know, the other aspect I would like to look for in here is really, you know, I need to get on newer inventory, but the kind of inventory that I'm looking for right now would be something like in the VIX. I'm going to look for some lower volatility, and if we get some of that lower volatility, you may see me start to allocate. Again, it's all about continuing to allocate, continuing to put on positions. This is inventory management, right? So inventory management, okay, and with lower implied volatility. And if we get that lower implied volatility, I may go out again 53 days out, put on a couple of VIX volatility spreads. I may even be able to pull off a few more risk twist spreads. And again, by using those, these are trades that are for outliers. These are trades that if the VIX, for instance, anytime in the next 50 or 90 days spiked higher, okay, I need those trades on. I need those trades on because I'm out there and I'm actually selling some premium right now. And to actually hedge off the sale of premium, I'm going to use these outlier trades, VIX volatility spreads, risk twist spreads. Last, but definitely not least, we actually jump back to the SPX. The SPX, in this next week of trade, volatility once again subsides. Now, this is a big, for me, kind of question mark, right? So I want you to look back at the last few weeks of trade with me. Just look back right here, okay? Look, the week we just passed through, we tagged the edge of the expected move. The previous week, we tagged the edge of the expected move. The week before that, we came a hop, skip, and a jump away from it. The week before that, we tagged the edge of the expected move. The week before that, did it again. I mean, again, from a probability point of view, we continually tag the edge of the expected move, okay? And what? We just passed through 4 trading sessions, 4 days, had an $82, expected move, and we hit it. And yet, they still take volatility down. So we're now coming into a 5-day trading week. 5-day trading week with plus or minus approximately a $73 expected move. We're looking for $73 higher, $73 lower. And I'm going to tell you right now, we're going to get every single ounce of that kind of move, right? So knowing that, right? Knowing that right now we've had a few really critical products kind of roll over, like the financials, like energy. We've actually seen maybe the dollar possibly bottom out. Maybe even the bonds are actually threatening to rally back up. I'm telling you, clean up your risk, people, okay? Clean up that risk. Know what your delta is. Recognize that the markets just feel like outright monopoly money. And there's one reality to this entire business. It doesn't matter what you think about a bubble. It doesn't matter. It doesn't matter what you think about the fundamentals of a marketplace that they don't exist. All that matters right now, okay? If people want their money out of this marketplace, it is not going to perform well. At any point in time, okay, people start to look at things like GameStop and recognize, right, that what? In stuff like GameStop, you're starting to see abject stupidity reign large. Anybody gets a little nervous, okay? You don't necessarily need to be the first one out the door, but you definitely don't want to be the last one out the door. Clean up your risk. Know your aggregated delta. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.